Hello everyone. In this video I'm going to talk about some of the more advanced option strategies. There are honestly quite a lot of them. Options can go really deep if you want, and I'm really only going to cover a few of the ones that I believe are more common or the terminology is more universal, because as you get deeper and deeper into options, you do come across scenarios where different brokerages will use different words to mean the same thing. And it's not necessarily that they'll use conflicting words with each other if you're switching platforms, right? It's more like there may be many words to describe the same thing. And I don't there are even things that just don't have terms out there. And frankly, I don't go that deep very often with strategies if I'm trading options, and I don't feel like I'm qualified to teach a lot of these farther off the record ones to people. But through a combination of the basic things that I've already mentioned and the more advanced things that I'm going to talk about today, you can really get to any feasible option strategy depending on how you want to combine them. And if you truly understand what these are, then you should be able to come up with things on your own if you decide you want to. But before I get into it, there's two things that I want to make sure to mention. The first is I have to apologize. I don't think my cat will be joining us today. She's currently in a box full of packing paper. And the second is that some of this stuff gets more into my opinion than actual stated facts. And I'm not a financial advisor, as I've clearly stated many times. So you should take my opinion for what it is, just an opinion of somebody who has experience with options, but is not necessarily the expert on them. So I think that covers everything I wanted to say before we got started. So the first thing I'm going to talk about are condors and butterflies. So if you remember from one of my most recent videos about the basic strategies with options, is I believe how I phrased it, you'll remember you can sell spreads, call or put spreads. So a condor or a butterfly is just kind of like doing both of those at the same time on the same underlying asset with the same expiration dates, etc. And basically you're doing this when you're expecting very little volatility, but the market may be expecting some more volatility than you think there will be. So you can just basically, like the picture shows, lock in profit when there's little or no movement. And the difference between a condor and a butterfly is basically just how much movement your strategy deems acceptable. A butterfly is very tight, right? If you want to view it as wings, the wings of your animal are very close to the core positions that are closer to the current strike price. With a condor, they're farther spread out, which is why it's got the condor name. So both of these are similar in that you're expecting little, or in the case of some butterflies, effectively no movement. These can be tempting, but finicky creatures depending on your trading platform. For example, if you do a condor with Robinhood, I think it is, you can end up kind of stuck in that condor and having a very difficult time closing your position, because you have to buy back your middle things and sell off your outside things, right? That you have to do the reverse of what you did if you want to buy out of your position, if you want to close your position. So that can be very difficult, because you can get into a position where no one wants to buy something that you originally bought to limit your losses. So those things at the far edges of the wings, right, the put that you bought or the call that you bought, can easily end up worthless to try to sell. It might end up being that no one is willing to buy them even for a penny. So in that case, some brokerages will more or less keep you from closing your Condor position. Now, I used Robinhood, and I can't remember for sure if that was the brokerage or not, so I guess don't quote me, and Robinhood, don't sue me. But I believe that was the case. Now, that's not always true, right? Sometimes these will come up as 4 separate options in your account, and you can close or add to them or roll them out or whatever, just like you would any other option if you just had one or had sold one alone with nothing else attached. So, I don't have charts for this, but a reverse condor, basically, it's the opposite of a condor or, I guess, a butterfly. You're pretty much just trying to profit off of extreme volatility in in an environment where maybe the market isn't expecting it, but you are. And every time I've been tempted to do a reverse condor, I have always not done it. Never done it. And the reason for that is it ends up costing you so much, because if you buy 2 positions, right, a put and a call, you have to earn enough money from the one that earns money. You have to earn enough to cover your losses on the other one. So that can end up making it feel like your position is swimming against mud, even if you should be profiting. And there are some valid cases, I guess, maybe to do them, but I just don't. If I'm expecting that much volatility, and the market isn't, I will either do nothing and watch if I don't have an idea of what way it's going to go, or if I think I know better, I will just buy a spread or buy even a naked option on the put or call side, whatever I think is going to happen. I really don't necessarily recommend the reverse condor strategy. Now, maybe somebody watching this disagrees with me. Feel free to leave your comment in the comments below. If you have the knowledge to disagree with me, this video again probably isn't meant for you, but I welcome your commentary, because I'm not really sure when I would want to use one of these either. I can see, I can Google, when should I do a reverse condor? Well, yeah, Google will tell me, oh, if you think there's crazy volatility. Yeah, well, it's going to be really expensive to get into if there's going to be crazy volatility too. Because if I think there is going to be a lot of volatility, most people probably agree with me. So then, of course, as I talked about in my original options video, the options get more expensive. So, I don't know. I'm not a fan, but now you know what it is. This one is one of the ones that I really think is relatively unique terminology to, who is it? I think it's the Tastyworks trading app. Again, if I'm wrong, don't sue me. But the idea here is that it's relatively similar to a condor in that you're expecting somewhat limited movement, but you're more afraid that maybe it will jump up, right? Like maybe there's been a rumor that you heard, or there's been some recent price trends that make you think that the price of whatever thing you're looking at may jump up. But you're not necessarily expecting it, you're just more worried about it. So in that situation, basically you do the whole iron condor thing, except you lop off one of the legs, right? You cut off a wingtip. You don't buy a put to cover yourself. So you sell a call spread, just like you would, right? Call, credit, spread. So that side of the what would be our condor is normal. But then on the put side, you instead just sell and don't cover your losses. Securing that put is cash. That's it. So your maximum loss would be if the thing goes all the way to zero, just like if you had sold a naked put and you had no calls going on. But well, that's not entirely accurate because you did profit off of selling the calls. So the idea here is that you aren't really, if you get blown through on the call side, that's not the end of the world because you're still going to have a net gain because your put that you sold, you profited more off of to begin with because you didn't spend money to secure it. You just used cash collateral. But if you start to lose on the put side, then you'll quickly come into an actual loss. And it is worth noting about this slide and the previous slides. Maybe I can go back here. It is worth noting that in these charts, in previous charts that I had done like this, I literally meant what I put on the chart for profit and loss. But condors don't work and butterflies don't work. Like, if you reach those sold strike prices on either side, you immediately just go into the red, right? You've already hit your maximum loss. They don't work like that. Don't interpret this chart that way. I put all four options on each chart just because that shows you where your strike prices are in relation to the current price. The bars are to highlight the green for maximum profit anywhere in that middle range, and red shows you anything but maximum profit. It does not show you maximum loss. Your maximum loss would be somewhere well beyond the put you bought or the call you bought. And the reason for that is you effectively sold two spreads on the same thing, right? So you sold two spreads on either side of the same option, or on either side of the current price on the same underlying asset. Woo! So you effectively sold two spreads, and that means that one of them is going to be gaining money for you, or drifting away from a loss, maybe I should say. One of them will be drifting away from a loss as the other is drifting towards a loss. So, as for example, if you blow through the call side on a condor, your put side will drift towards worthless. And you sold it, so you want to drift towards worthless. And the call side is what's going to be losing you money if the price of your underlying asset blows through your call side. But there's a point where you actually still do, of course, lose money. And usually that's going to be beyond the far wings of your condor. But it really depends. And that's a reason that I didn't put the right colors in. It just really depends. It depends on how wide your condor is from the current price and how big your wings are to where you're buying. And it's the same for a butterfly. There's so many variables involved with that. And even I've seen, like, one example was Beyond Meat. Right, they had a huge price jump. Oh, I don't know, in 2018 or 19 or something. I don't remember for sure. But they had a big price jump. So if you were to try to buy a put option, it cost like 3 or 4 times more or something ridiculous than a call option. So that means your profit on selling spreads on either side of the current strike price was uneven. And because your profit from making the sale on day 0 was uneven, your losses could also be uneven, and your break-even point was somewhat biased towards one side. So there are so many variables, and that's just why I didn't include any other colors here. So, going back to the Jade Lizard though, I still included the other color, not because at that exact moment is where you drop to some middle point between maximum gain or maximum loss, and I didn't include or put red there, again, just like a condor. I didn't put red there because that's your maximum loss instantly as soon as you cross that threshold. It's just to highlight which region your maximum loss is in. So somewhere, if the current price of your underlying asset drops below the strike price of the put that you sold, somewhere in that region is your maximum loss. But on the other side, in that yellow area, you just can't get to your maximum loss because you theoretically took in more money on the put side. So nothing that happens to the call side, unless you have a super wide spread or something, right? Like, nothing that happens on the call side will get you to your maximum loss. Now, I know I just said it, but it's not strictly the truth. I'm talking about more like conditions where I have done this in, right? A scenario where I've done a Jade Lizard, and I've done a handful of them. I didn't know that's what they were called at the time, and it's not, I don't think, an especially well accepted term. But under the conditions where I've done them, it's always been because I was more afraid of the call side and that getting blown away than the put side. But I still thought there was opportunity there, so I still did it. And it's really how you feel is how you feel when you're looking at a strategy like this. So, buyer or seller beware, I suppose, just like with anything else with options. But you can theoretically get into a case where your highest risk is still on the call side. It's not as common, at least in my opinion. So, calendar spreads. These are pretty interesting, in my opinion. So basically what you're betting is that there will be relatively low volatility in the short term, and in the long term the volatility will increase at an uneven rate. So I just gave two examples here of a call debit calendar spread, and despite what's in the picture, that should be a put spread. So the idea is that you're selling something close, right? Close in time that is going to be worth less than something farther out in time. So it's a debit. And you may sell two things at the same strike price even if you want. Or sell one and buy one, I mean, at the same strike price, just on different days, right? As long as you are buying one farther away in time, not in money, in time, it will still be a debit because that one will cost more than the closer one in time. So again, the idea is that you're predicting low volatility short term and then an increase in volatility. One example where I've done something like this was Boeing. They were having a pretty big problem with the 737 MAX, as some of you may be aware. So basically I was betting, after a point, I basically bet that, okay, I think we're done with that mess now, but it'll be a long time before it gets better. It won't get worse, but it'll be a while before it gets better. So I did a calendar call debit spread, where basically I sold a call fairly close to the money and fairly close in terms of an expiration date, and then I bought a call a little farther from the money and much farther away in expiration date. And I think I got out of it early for a very small profit, but that's just the general idea. And on the put side, you have basically the opposite, right? So if you think that a company may lose their shorts, boy, what would be an example of this? If you think there's like a technology ready to disrupt a market, or you think after the pandemic is over, some of these digital companies like Zoom are going to die, you may be tempted to do a calendar put spread, put debit spread on them, where you sell a put fairly close to the money and fairly close in time, and then you buy one farther away in both of those aspects. So you're basically saying, I think after the pandemic, Zoom is going to drop in value because it exploded in value because of the pandemic, or at least partially because of the pandemic. Again, that's not investment advice. I have not done that. Full disclosure, I have not done that. In fact, right now, I think I have very few positions in any of my accounts, and I certainly haven't given any examples of positions I currently have. But that is, those are calendar spreads, and they are usually debit, and there's a good reason for that, even though it may not be very intuitive. Debit meaning you're spending money on them. The credit side looks a lot weirder. So I only did one example here. Calendar call credit spread. Whew. I bet you weren't quite ready for tongue twisters. I know I certainly wasn't when I started this video. So a calendar call credit spread is basically you're expecting high volatility in the short term and low volatility in the long term. But even that won't actually make it a credit, right? So you actually have to basically try to sell one at a lower point farther away, or at a higher point farther away, and take in more money than you spend on the close one, close to the money and close to the expiration date, right? If you're buying that one and then selling the one farther away to make money, your only options are really, realistically, to do them at the same strike price and hope that whoever buys the one you're selling farther away does not execute it, or to sell the farther away one in calendar time slightly higher, slightly farther away in money as well, to avoid having that executed and bet that you'll be able to execute yours that you are buying close in calendar time and in strike price. And if I haven't convinced you yet, by nearly confusing myself and certainly confusing you, that this is not a good idea, the reason you don't do that is this one example where I sold one and bought one with the same strike price, right? Level line, but different dates. So the one I sold is farther away than the one I bought. So you might, in calendar time again, so you might say, oh, well, that would work, wouldn't it? If you thought that there would be a pump of the underlying asset and then it would drop back down below the other value. Except, in in American style options, you can still execute before the expiration date. So there's nothing to stop that person I sold the option to that's way out in the future sometime with an expiration date out there. There's nothing to stop them from executing it whenever they want. There just isn't. So, how do I know they won't execute it and eat away a lot of my potential profit in this particular example by executing it at the right time? I don't know. They can do that. Just as I could execute mine early, right? If I wanted. So this particular version of it, where you buy and sell the same strike price, just different expiration dates, doesn't make sense to do in a credit. And the other example that I gave, where you could sell one just higher, a little bit higher, so instead of having your sold with the same strike price, you can move it out farther enough that you can lift the price a little bit compared to your bought one, right? So sold and bought instead of sold and bought being on the same line, right? They're uneven, so sold, bought. But you have to move this guy out, the selling one, so far that on the calendar that you can still have a credit spread. And oftentimes to do that, you end up with a strike price on the sell that's very close to the bought, but a big calendar gap. It depends a lot on the underlying asset, but at least intimidating calendar gap between the two. So what are the actual odds that yours that you're buying here, right, will make you money, and this one will lose that person money, right? There's just, why do that? You're almost guaranteeing that in one way, shape, or form something can go wrong. There are better ways to handle that, in my opinion. Again, this is definitely my opinion. There are much better ways to handle that situation. Maybe you would rather sell just a regular call spread, because what you actually wanted was to not have to pay as much for your call option that you're buying, right? So I don't know. There's better ways to do it, and I'm not going to go deep into examples, but I would avoid this. So that is the last of the advanced strategies that I'd like to talk about. If anybody comes up with any more that they think I should have mentioned, feel free to leave them in the comments below. If this confused the living daylights out of you, don't worry, it took me probably a few months to actually understand any of this, and an even longer amount of time to understand it well enough to begin to teach it at all, even to the level that I am here. So, I think that's the end of my options series, and I will see you guys in the next one, whatever that may be.